and welcome to this week's question and answer video series brought to you by the Weekly Advertiser and Meriton Financial Group, where you have the opportunity to have your financial related questions answered. Today's question looks at superannuation planning. So here's the question. I'm approaching 55 years of age and have $2 million in superannuation, which includes farming land with a lease of $60,000 per year. I'm wondering what are the benefits of commencing a pension at the age of 55 and what would be the minimum amount I need to take out each year? Well, thank you for the question. When deciding whether to commence a superannuation pension between the ages of 55 and 60, it's often well worth to run some calculations. As we know, from 60 onwards, lump sums or pensions paid from superannuation benefits are tax-free. However, between the ages of 55 and 60, this is not the case. To determine whether it may be advantageous to commence a pension from age 55, we need to consider the taxable components of the fund. I've made the assumption that of your total fund valued at $2 million, $1 million is tax-free and $1 million is taxable. The tax-free component is made up of money contributed to the superannuation using after-tax money. This is known as a non-concessional contribution, or in the past, a personal contribution. The taxable component is made up of pre-tax superannuation contributions, where you have reduced your taxable income via a concessional contribution. These contributions can be made up of your employer's 9% super contribution, a pre-tax salary sacrifice contribution, or a lump sum contribution where you're self-employed, which enables you to reduce your taxable income. In relation to how much money needs to be taken out between the ages of 55 and 65 for the 2013 financial year, we'll need to take out at least 3% of the fund value at the 1st of July. If the pension starts partway through the year, the income payment can be prorated based on the amount of days remaining in the financial year. This 3% minimum drawdown amount is currently a 25% discount to the legislated amounts. So at the end of the video, we'll put up a table which shows the minimum annual payments for this financial year, and then it would also revert to the legislated minimums for 2014. So based on this information, we're able to make an assessment of the potential tax outcomes. You've mentioned that you get $60,000 in farming lease each year. I'll also assume that you're earning another $30,000 from income from the other investments in the fund, giving a total of income of $90,000 per year. Now, one of the main benefits of commencing a pension is that the income received by the investments backing the pension are taxed at 0%, whereas the same income in an accumulation phase of superannuation where you're not drawing down on the fund is taxed at 15%. So based on this scenario, the taxable income within the fund of $90,000, there's going to be tax saving of $13,500 per year. And this is the difference between the 15% tax within the fund and the 0 within the pension fund. If this fund was to then be transferred to the pension, the tax paid internally will be 0, giving significant tax saving. So this is the carrot. Now we need to consider what are the tax consequences of drawing down a pension of $60,000 per year, which represents 3% of the $2 million invested. $30,000 of this income would be completely tax-free, and $30,000 would be taxable, which will be based on the taxable and tax-free components within the super fund. The taxable income of $30,000 also comes with an extremely attractive tax rebate of 15%, or $4,500. We now need to add the taxable component of $30,000 to your total income for the financial year to be taxed at your marginal tax rate. So this is where we now need to make a few assumptions. Let's first make the assumption that you're on the highest marginal tax rate and paying 46.5% including Medicare. This amount is applied to the $30,000 worth of taxable income from your pension, giving us $13,950. Then we need to take off the 15% tax rebate, or the $4,500, giving you total tax paying $9,450 in tax payable. Now, if we are to compare this to the tax saving by not paying 15% on the earnings within the fund of $13,500, it gives us a yearly tax saving of $4,050. Now we can make the assumption you're on a lower tax rate, this time at 38.5%. This equates to $11,555 in tax. Then we take off the rebate of $4,500 and gives us tax payable of $7,050. If we compare this amount from a tax savings point of view, you'll end up saving $6,450 per year when compared to the 15% tax rate within the accumulation mode. So in these instances, it'd be well worth commencing a pension, though there's a few things you need to consider, like is there any extra administration costs to commence a pension, and also the increasing minimum pension payments, which will come into effect in 2014, which will increase the amount that you need to take out and therefore increase the taxable component. So for those considering taking up a pension from age 55, it's well worth looking at the figures, especially with those with larger superannuation balances with a high tax-free component, like the above example. If you have a lower tax rate, this will also increase the attractiveness of the strategy. Please remember this is general information only, and that, as you can see, we've made a lot of assumptions. So if you need personal advice, please speak to a suitably qualified financial advisor that takes into account your specific details before giving you advice. Please read our disclaimer at the end of the video. So thanks very much for sending in the question, and thank you for taking the time to listen. If you have your own question that you would like answered, please go to our website and submit your question there. We don't use anyone's names when answering our questions to protect everyone's personal details. Thanks very much for taking the time, and we'll see you next week.